Hi everyone, in today's video we're going to be talking all about taxes and specifically what happens to your taxes in retirement. For those who don't know me, my name is Riley Siltman and I am a certified financial planner professional. One of the biggest misconceptions about retirement is that your taxes will automatically go down if you stop working. And while this is often the case, it's not always the case. I've found that many retirees are surprised about the taxes that they see in retirement. Between Social Security, retirement account withdrawals, investment income, and even pensions, your retirement tax situation is often more complicated than your working years. Now, the good news is that understanding how taxes work in retirement allows you to be proactive and make good decisions before and in retirement. In today's video, I'm going to explain what happens to your taxes in retirement, which income sources are taxable, and how you can prepare for all of this. Let's get started. When you're working, most of your income comes from a paycheck. In retirement, your income may come from different sources: Social Security, traditional IRAs, Roth IRAs, 401ks or Roth 401ks, brokerage accounts, pensions, the list goes on. The challenge is that each one of these income sources can be taxed differently. Let's start with traditional retirement accounts. This would include your traditional IRA and your 401k or 403b. Often a big surprise for retirees is that the income coming from a 401k, IRA, or 403b is completely taxed as ordinary income. When you contributed to these accounts, you likely received a tax deduction. The trade-off is when you take the money out of this account, the IRS gets their share. For example, if you withdraw $40,000 from your IRA, generally that $40,000 is added as taxable income for that year. Many people spend years building these accounts, but forget that eventually when the money comes out, it's taxable. Another common misconception is that Social Security is always tax-free. This is not true. Depending on your income, up to 85% of your Social Security benefit may be taxable. The more income that you have from sources like part-time work, IRAs, or pensions, the more likely that more of your Social Security benefit will be taxable. This often catches retirees off guard because they assume that these Social Security checks won't affect their tax return. Another part of retirement that retirees need to be aware of is required minimum distributions, or RMDs. Once you reach a required age, the IRS forces that you take out a minimum amount of your pre-tax accounts every year, even if you don't need the money. These withdrawals are generally taxable and affect your taxable income directly. The larger your pre-tax retirement account is, the larger your required minimum distribution will be. If you have a pension, these are generally completely taxed as ordinary income. This means that pension benefits directly impact your taxable income and therefore can directly impact your Social Security taxation. Pensions are a fantastic benefit, but it's important to understand the tax implications. Now let's talk about brokerage accounts. Unlike traditional retirement accounts, not every dollar you take out is taxable. In many cases, you'll only pay taxes on the gains when the investment is sold. Long-term capital gains often receive favorable tax treatment compared to ordinary income tax rates. This flexibility can make a brokerage account a valuable tool in retirement. Roth IRAs are often one of the most tax-efficient accounts in retirement. This is because qualified withdrawals from Roth IRAs are completely tax-free. That means that you can withdraw from both your contributions and earnings without paying any federal income tax. Roth withdrawals also generally don't increase your Social Security taxation. Many retirees don't realize that income can impact your Medicare costs. Large IRA withdrawals, RMDs, or other sources of income can impact your Part B or Part D premiums, along with being subject to something called IRMA, or income-related monthly adjustment amounts. One of the best ways to prepare for retirement taxes is to have different buckets of taxation, otherwise known as tax diversification. For example, you have your tax-deferred accounts. This would be your traditional IRA or traditional 401k. Your tax-free accounts. This would be your Roth IRA or your Roth 401k. And you have your taxable accounts, otherwise known as your brokerage accounts. Having multiple account types with different taxation allows you to have more flexibility and control over your tax situation in retirement. Overall, retirement does not mean that your taxes disappear. Understanding the different ways that income is taxed in retirement allows you to make better financial decisions before and in retirement. If you'd like any help with your tax planning in retirement, feel free to reach out. If you like videos like these and would like to continue learning more, please consider liking and subscribing. Thank you for watching and take care.